Hey everyone, welcome back to Corporate Decoded, the place where we pull back the curtain on the world of business and sometimes find a few skeletons in the closet. Today we are diving deep into Focus Universal Incorporated's latest -1 filing. Buckle up because this one has more twists and turns than a pretzel made of red tape, and frankly, it is a fascinating look at a company trying to navigate some pretty choppy waters. Before we get into the nitty-gritty, if you love cracking open these complex corporate documents and getting straight answers, make sure you hit that subscribe button, and hey, we have a fantastic community over on our Discord server, linked in the description, where you can connect with fellow finance enthusiasts, so definitely check that out after this. Alright, so Focus Universal Incorporated is filing this document to register more shares of their stock. Think of it as them saying, hey, we've got these shares and we want to make it official so they can potentially be sold later. This isn't about them raising money right now, but rather allowing existing shareholders, called selling stockholders, to sell their shares. They have to do this because of certain agreements they made when these shares were originally issued. The big number here, up to 10,558,975 shares of common stock. That is a lot of shares. These shares come from something called Series B convertible preferred stock. Imagine preferred stock as a special kind of stock that can be turned into regular common stock later. This deal happened in a private placement, meaning it wasn't sold to the general public initially. The company itself is not getting any money from these sales. The money goes to the selling stockholders. We will bear all costs, expenses, and fees in connection with the registration of these securities. That is good for the sellers, but it is a cost for the company to keep in mind. Now, let's look at the money talk. This is where things get really interesting and frankly, a bit concerning. Let's start with the most recent quarter, the 3 months ending the 30th of September, 2025. Revenue was $28,689. Now, that might sound like a decent chunk of change, but compare that to the same period last year, the 30th of September 2024. When revenue was $74,215, that is a drop of over $45,000, almost a 60% decrease, and it gets worse. Their cost of revenue, what it costs them to make or acquire the products they sell, also went down, but not enough to offset the revenue drop. This resulted in a gross loss of $1,612 for this quarter, compared to a gross profit of $31,685 last year. So they are losing money before even considering their other operating expenses. Looking at the 9 months ending the 30th of September 2025, the story is similar, though less dramatic. Revenue was $254,274, a slight decrease from $264,954 in the same period last year. However, their cost of revenue jumped significantly from $127,686 to $237,754. This increase in costs, coupled with the slight revenue dip, caused their gross profit to plummet from $137,268 to just $16,520. That is a massive 88% decrease in gross profit. It means for every dollar they bring in, a lot more is going out to make it happen. This downward trend in revenue, especially the significant drop in the most recent quarter, is a red flag. It suggests their products or services are not selling as well as they used to, or perhaps they are facing much tougher competition. Now let's talk about their expenses. For the 9 months ending the 30th of September 2025, total operating expenses were $3,994,663. Last year, for the same period, it was $4,192,206. So, they did manage to cut down on their expenses somewhat, which is a positive sign in terms of cost control. One notable expense reduction is in compensation for officers and directors. It dropped from $687,303 to $375,725. This is likely due to the decrease in stock price, meaning their stock-based compensation, which is a big part of executive pay, became less valuable. However, their research and development costs actually increased from $948,041 to $1,127,633. This could be a good thing if they are investing in new, innovative products that will drive future growth. But given their current financial situation, it is a risky bet. And then there are the professional fees, which shot up from $985,368 to $1,224,063. This increase is primarily due to higher legal fees, likely for that employment litigation defense we saw mentioned in the risk section. Legal battles can be incredibly expensive and a major drain on resources. All these factors combined lead to the bottom line. For the 9 months ended the 30th of September 2025, the company reported a net loss of $3,923,401. That is a significant increase in losses compared to the $1,238,776 loss in the same period last year. It appears they are losing money faster than before, despite some efforts to cut costs. Let's look at their balance sheet. As of the 30th of September 2025, their total current assets were $771,077, but their current liabilities were $705,638. That leaves them with working capital of just $65,439. Working capital is basically the money a company has readily available to cover its short-term debts. Having such a small amount of working capital is a major warning sign for financial health. It suggests they have very little buffer if unexpected expenses pop up or if sales continue to falter. When we look at cash flows, the picture is not pretty. For the 9 months ended the 30th of September, 2025, they used $3,709,104 in cash from operating activities. This means their core business operations are burning through cash. Last year for the same period, they used $3,658,901. So the cash burn from operations is actually increasing, not decreasing. Interestingly, in the 9 months ended the 30th of September 2024, they had a massive cash inflow from investing activities of over $7 million. This was primarily due to the sale of property where they brought in $7,145,808. This sale clearly provided a much needed cash injection, helping them stay afloat. Without that one-time infusion, their financial situation would look significantly worse. On the financing side, for the 9 months ended the 30th of September 2025, they had cash inflows of $572,826 from issuing stock. This indicates they are raising money by selling more shares. However, this is offset by purchases of treasury stock, which means they are buying back some of their own shares. Now, for the big risk factors, they straight up admit they have a history of operating losses. As of the 30th of September 2025, they had an accumulated deficit of nearly $30 million. That is a lot of red ink. They also mentioned substantial doubt about their ability to continue as a going concern, which is a fancy way of saying they might not be around in a year. This is a significant concern for any investor. They need a lot of money, up to $20 million, to get their Ubiquita wireless sensor off the ground. If they can't get this funding, their whole plan could fall apart, and there is no guarantee they will get it or that it will be on good terms. Their success hinges on a few key people, particularly their CEO and chairman. If these individuals were to leave, it could create serious problems, especially with their limited financial resources. They outsource manufacturing, which means they have less control over quality and production. They are also particularly reliant on a single manufacturing partner for some key products, and they don't even have a formal contract with them. That is a precarious position to be in. They used to rely heavily on one big customer, but now they are trying to spread their customer base. While diversification is usually good, migrating away from a steady customer can also introduce new risks as they build new relationships. They are also worried about short selling driving down their stock price. They believe their stock might be unfairly targeted. This could lead to even more volatility and potentially lower stock prices. And then there is the dilution risk. They have the authority to issue a massive number of shares, up to 1 billion common shares and 100 million preferred shares. If they issue a lot more stock in the future, your ownership percentage in the company could shrink significantly, meaning your stake becomes less valuable. This, combined with their convertible preferred stock, which can be turned into common stock, means your ownership could be watered down considerably. It sounds like they are planning to issue a lot more stock in the near future, especially with that Series B preferred stock that they are registering to be sold. Now, let's look at their strategy. They are focusing on their universal smart technology and financial reporting software. They believe their technology can revolutionize the Internet of Things industry by reducing costs and improving efficiency. They are also working on ultra-narrowband technology for 5G, which they claim can offer higher speeds and better coverage with fewer subcarriers, potentially saving costs. Powerline communication is another area they are developing. Their strategy seems to be a two-pronged approach. First, target industrial sectors with their universal smart technology, then eventually bring it to the consumer market. They aim to grow through mergers and acquisitions too, which can be a fast way to expand, but also a risky one. They are also exploring technology licensing. Looking at who owns what, it is clear that the company's leadership holds a significant chunk of the stock. Desheng Wang, the CEO, owns over 30% and Edward Lee, the chairman, owns over 21%. Together, the directors and executive officers own about 49% of the outstanding common stock. This concentration of ownership means they have a lot of control over the company's decisions. While leadership involvement can be good, it also means that if their interests don't align with other shareholders, it could lead to conflicts. They have had some significant related party transactions, including loans from entities connected to their shareholders and loans from their CEO. These loans were paid off, but it highlights how closely intertwined some of the company's financial dealings are with its key people. And investors, this isn't unusual, but it is something to watch. Focus Universal Incorporated is authorized to issue a massive 1 billion shares of common stock, plus 100 million shares of preferred stock. As of the 16th of December 2025, they had about 8.2 million common shares outstanding. But remember, they also have preferred stock, including Series B convertible preferred stock, that can be turned into common stock. This means the number of outstanding shares can increase significantly. This section details the Series B preferred stock deal. They sold up to $7 million worth of this stock at a price of $850 per S-share, but with a 15% discount. This stock can be converted into common stock, and the conversion price is tied to the stock's market price. They even have clauses in there that can trigger a reverse stock split if their stock price falls too low, and the investors can demand redemption of their shares after a certain period. It is a complex deal designed to protect the investors. Here we see the names of the selling stockholders: Great Point Capital LLC, Target Capital One LLC, and Secure Net Capital LLC. These are the entities that will be able to sell their shares into the public market, potentially creating a lot of selling pressure on the stock. They could collectively own over 10.5 million shares of common stock once they convert their preferred stock. So what is my take on all of this? Focus Universal Incorporated is facing significant challenges. Their revenue is declining, their costs are rising, and they are losing money at an increasing rate. They have very little working capital and a history of operating losses. So much so that they themselves acknowledge substantial doubt about their ability to continue as a going concern. The sale of property provided a crucial cash infusion, but it is a one-time event that won't solve their underlying business issues. Their strategy involves new technologies and software, but these are largely unproven in the market and require substantial funding. The concentration of ownership by insiders means they have control, but it also raises questions about potential conflicts of interest. The significant number of shares being registered for resale by selling stockholders could also put downward pressure on the stock price. Overall, this filing paints a picture of a company in a precarious financial position, making bold bets on new technology while facing a declining revenue stream and a high burn rate. The short-term survival hinges on securing that $20 million in funding and successfully commercializing their products. It is a high-risk, high-reward situation, but right now the risks seem to heavily outweigh the potential rewards. There is a long road ahead if they plan to become a stable, profitable company. Alright, that is our deep dive into Focus Universal Incorporated's latest filing. What do you think about their chances? Are they on the verge of a breakthrough? Or is this a case of too much ambition and not enough runway? Let me know your thoughts in the comments below. And if you found this analysis valuable, give this video a thumbs up and subscribe for more corporate breakdowns. Don't forget to join our Discord community too. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.